So if I'm allowed $1,000 risk, and it was $1,000 risk at that deeper stop to there, and I now reduce that, I've bought the right to wait up, to maintain myself at that $1,000 risk if that is run. These squeezes are rare opportunities for tight risk and asymmetric reward. Let's say you're not a trader, this is all just too technical for you. It's a great time to buy investment gold right now, in my opinion, and capture the prices here, and through the next few days into midweek might come off a tiny bit. My expectation is you're going to be taking the next big peg levels in those derivatives. It's called pegging because of derived markets on those round numbers. And I think it's north of 37, potentially 3750. So gold, very positive.
Gold continues to trade near the upper bounds of its multi-month rally, advancing from around $2,000 in late 2024 to a high just under $3,500 in mid-2025. This move signals a significant shift in capital allocation, as investors reevaluate portfolio risk amid inflated equity market valuations, stubborn inflation, and intensifying geopolitical stress. After clearing the $3,000 mark, gold experienced a brief consolidation before resuming its climb, particularly during the height of the tariff tantrum in early 2025, an episode defined by heightened trade friction and policy uncertainty that triggered safe haven demand and propelled gold prices to test the key 3,500 resistance level. Since then, gold has retraced marginally and is forming a stovepipe structure between 3,120 and 3,500. A classic consolidation range following a sharp upward advance. Market strategist Francis Hunt observes that this narrowing band of price action signals a latent buildup of market energy. With the range defined by lower highs and higher lows, Hunt explains that volatility is compressing as market participants await a directional resolution. Round number thresholds, such as 3,500 and 3,700, carry psychological weight for large investors and algorithmic traders, creating liquidity zones just above resistance levels. When those thresholds are breached, these concentration points often give way to rapid price acceleration, drawing in additional momentum buyers. Hunt suggests that once gold breaks above this range, the next target is logically in the 3,700 to 3,750 zone, driven by the convergence of technical catalysts and persistent demand from global central banks. For investors, the current consolidation offers a compelling opportunity to position ahead of a potential breakout. Hunt recommends accumulation in the 3,200 to 3,295 support zone, paired with clearly defined stop-loss levels to safeguard against downside risk. This strategic entry aligns both technical structure and fundamental context, as gold continues to serve as a hedge against systemic risk, currency debasement, and rising demand from sovereign reserves. With central banks diversifying away from fiat currencies and market volatility elevated, gold's monetary role is becoming increasingly critical. Hunt emphasizes that for investors seeking durable portfolio protection in turbulent environments, gold remains a foundational asset, positioned to lead the next phase of the rally. Now, we present the clips from Francis Hunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I can say to you, we made 3,500. Let me get that share screen up and running. Some folk have been a little bit impatient because, we kind of made 3,500. You may recall, Elijah, we were with you on show and when we were on a 2,000 point, and we pointed out there's an HVF structure just sitting on top of the 2,000. The low was about $2,011, and we said, next stop 3,000. That was a big move. It was a breakout. We said once, twice, three times a lady. We showed you that technically. And we made that 3,000. We had a little bit of pullback, but actually we continued. We had the tariff tantrums, and actually we got a second surge that took us to the logical next round number that sits between 3,000 and 4,000, and that was the 3,500. So that is a touch just at the 3,500 level after passing the 3,000, which is somewhere down here. And this has formed a beautiful continuation pattern. Initially, there was some hard selling. You could see strong selling off leg there, a bounce, selling off, a bit of volatility and chop going into a 3,120 low. That kind of defined the range, 3,500, 3,120. And what we've been doing is we've been tightening with inside that range. And the overall opinion is continuation is expected. So this is a continuation pattern. It's also a volatility constriction continuation pattern, which is likely to lead to a tightening that gives you built up pressure that powers the next leg up. And we've been performing beautifully towards that. So just to change to a slightly more shocking pink color there, this is a simplistic, diagrammatic from the pivotal highs to the pivotal lows. We're kind of here. We look a little bit toppy. I think we could roll over for a semi-dip more. We might even make it here. So I'm not saying this is the absolute final low, but this is a squeeze. And we often say that. We sometimes say squeezy, squeezy, Japanesey, and as kind of catchphrase for us. So we have a defined range, which was that high and that key level, which sits between 3 and 4K, the obvious round number 3.5. I've drawn the blue line there for that. We sort of had a low level at around the 3,120. And what's actually happening is we've made a lesser high and a higher low. So this is constriction. This is the ironing out of the volatility. And what tends to happen after you've made a kind of really substantial move. Don't forget, we were at 2,000 November 24, and we said 3,000, and you've done 3.5. Now, done. We did just a technical touch and pull back. But that's a really substantial move, an excellent move. And it's understandable now that you'll have a bit of a rest period. This was April, I think, the high. That was peak tariff tantrum. That is a key moment, by the way. I'll point out to our American audience, hello and happy birthday to you all. Just missed your July the 4th, but wishes to all your American followers. What's happened, that was peak tariff tantrum. And on that day, rates spiked up, the dollar went down, and gold blew off to that 3.5 high. It takes you back to April. And then tariffs were walked back. The tone was changed after quite an inflammatory tone. So that just warns that every time rates go up doesn't always mean the dollar goes up. Just a little bit of a warning, because there's some people with adverse messages. It can mean that, and it could still happen. I'm not saying it won't. But if you're seeing divestment out of America, and that doesn't always mean foreigners, by the way. That was actually American wealth that went offshore. So treasuries were sold, turned out of dollars, into something else, and I will show you what I think it's been, because it's certainly been gold as part of that. But in the fiat world, there also has been a bit of a run into the Swiss francs. IMF published its latest COFA data yesterday, which tell us how official FX reserves are allocated across major currencies. Remember, gold is not quite as liquid as a fiat, which can just straight away be sent on a SWIFT system anywhere in the world. People still need a fiat. They just want the least bad one, given that they're all largely bad. Which is the least bad one? Q1 2025 saw a massive big jump in Swiss franc allocation, which did not come at the expense of the US dollar, however. I would argue that it did. I don't see how they can say that. I think there's been an increase in gold, and that is an anti-dollar trade, even if your dollar stood still. And there'll certainly be a decrease possibly in euros moving into the franc. We've had the euro-Swiss franc collapse before, and the Greek crisis as well. So the franc has been a winner as well as gold, but the long-term winner for balance sheets and assets is without doubt gold. But I just thought I'd throw in that extra little point in of order that people are choosing the least bad fiat. It is, of course, a lot smaller, and even a small amount of dollars going into a Swiss franc causes a disproportionate move. We have been Swiss franc long, Japanese yen short, because we feel the Japanese yen is the wholesale currency for cheap borrowing for America, and that the carry trade runs a lot deeper. And our technical analysis gave us that trade, but fundamentally, that's my feeling of what the story would be. So there's a bit of fiat news for you, but in the end, gold wins, and this move is looking for 3,700, 3,750. So between 3.5 and 4,000, the next logical level, and this has derivatives and pegging as part and parcel of this, and you tend to have sort of orders stack in a bid stack around round numbers. That means you tend to get vacuums. If instead of everything being evenly distributed You tend to get vacuums just before logical round numbers, and then many more orders stacked at the round numbers. And we call that voids and vacuums. And that sees you move very fast. And you make the same profit when you cover a $10 move, whether it's $10 between 69, 3,669 and 3,679 versus 3,690 to 3,700 or 3,740 to 3,750. It's still $10, but you will get different degrees of stacking in depth across it's not evenly distributed, and you tend to get very quick moves in the numbers before round numbers, and it builds momentum, and then it often shoots through, and then it pulls back through the round number. So our expectation is there's a 370 run in this setup. This setup isn't necessarily complete, and I think it can come a little bit down, but I don't see it coming all the way down. I think buy limit orders in a box round here for investment gold would certainly be a great entry, and we are actually taking a trade on that, which we expect. We're not day traders. We'd expect the entry to occur midweek next week in and around that pink box level, and then we'd expect to see a 370-750 run.
During the interview, market analyst Francis Hunt expressed concerns about silver prices, despite acknowledging the metal's potential upside in the current precious metals rally. Hunt pointed out that while silver traditionally follows gold's lead and often demonstrates stronger percentage gains during bullish phases, its price dynamics are considerably more complex and risk-laden. Unlike gold, which benefits from consistent demand by central banks, institutional investors, and sovereign wealth funds as a trusted store of value, silver's market is more susceptible to speculative trading and industrial demand fluctuations. This inherent volatility means that silver can experience sharper price corrections, especially during periods of financial stress or economic uncertainty. Hunt further elaborated on the behavior of the gold-silver ratio, a key indicator for investors assessing relative strength between the two metals. Historically, during sustained bullish trends in precious metals, the gold-silver ratio tends to decline, signaling silver's outperformance relative to gold. However, Hunt cautioned that this pattern is not guaranteed in all scenarios. He stressed that in times of acute market crises or liquidity shortages, investors often prioritize gold as the ultimate safe haven asset, leading to a potential divergence where silver underperforms or even declines. This occurs because gold attracts significant buying interest from central banks and long-term holders who seek stability, whereas silver's more speculative and industrial-linked demand can evaporate quickly under pressure. Consequently, while Hunt maintains a cautiously optimistic view on silver's medium-term prospects and recognizes the likelihood of further gains, he advises investors to remain vigilant. The metal's price action will likely remain tethered to gold's performance and broader macroeconomic developments, particularly in a fragile economic environment where sudden shocks could disrupt market dynamics and trigger volatility in silver prices. Let's get back to the interview.
If I'm bullish gold, should I not be bullish silver first of all? And then the question becomes which one outperforms. In other words, does the gold-silver ratio continue on its downward trajectory? During the bullish phases, I think yes, that it continues on its downward trajectory. So typically, if they're all going up, I'm going to expect the gold-silver ratio to come down. Let's go have a look at that silver on its own, and I'll come back around at the same time frame and answer more specifically on the gold-silver ratio. I want to highlight a couple of things that happened previously as well, because I think we're getting a little bit of a doubling up event as well. Let's go to the 4-hourly time frame a little bit lower. I'm even more bullish the silver now. So some people will say, but hold on, weren't you the guy that also said the gold-silver ratio could spike higher? Yes, we'll come back to that, and I am that guy, and we'll explain that. But right now, that's not the highest expectation. We had two wind-ups here. One was a fractal of the other. We got part break, and then we overperformed for the target. The target, this was quite low. In fact, these lows were in and around 31s, by the way, so we're doing well. We're working our way up. Some people are, there's not enough gratification. Setups all the way, overperformance to targets, and then there was a degree of exhaustion. So what happened is you got a big setup, and then you got a secondary setup. And then once it started to move, you got a fractal, a third, smaller one, that continued to drive us higher. So there's a little bit of similarity here, and I'm going to show you why I say that. So we drop down to the current price behavior a little bit more closely, and I'm going to throw my indicators on to make these things pop a tiny bit more for the untrained eye. So that in itself is a winding up setup. That is suggesting $38.28. Remember last time we got an overperformance on the big one with the second helper that came along. We've got a similar situation with a little bit of a helper over here as well. Again, it might not pop for the untrained eye, so I'm just going to highlight it. But you're in there. So you sometimes have initially a slow start and you wind up again. Now, we maybe just didn't get the right data about unemployment or something else and wanted to go, but it was a bit of a hard sell into the wrong kind of news. So it coils a second time on a smaller time frame. So we've got that happening, and I'm going to put again the indicator on that, and I'm going to stick it on there, and you will see that again we've got a little bit of a wind up suggesting that we're going to go again. So it's getting a little bit busy there, so I don't want to overcrowd the chart, but that's all pointing to the potential of 38.28, but potential overperformance to that, because that's what happened last time. We got one setup, it wasn't quite the right moment, it started its move but went into a holding pattern and squeezed again, and then it was released and then it overperformed. And it seems like that as well. So it's hurry up, start, relax, wind up some more, and then go. And I'll just point this out as an interesting repetition, like a sort of a mini cycle repetition. And so we're very bullish on silver right now. And I think in percentage terms, that's going to be an outperformance to gold. Gold going from roughly where it is, around the 3,300s right this minute, going to 3,700, let's say. That's about $400 on a 3.3. $300 would be about an 11th, so it's a little bit more. It's about 15-20%. I would imagine that we'll beat that on the silver here, and we could also be beating it on the platinum. That's almost the contest actually for the outperformer for me, those two at the moment. But you need the king, the old aging king, to get up from his table first and move. So we're very dependent on gold going up. If the gold pattern fails or extends a little longer, all of this will be also put on ice again for a while. So please understand, it's a bit like the altcoins can't go up if Bitcoin doesn't. Only gold is the original and silver is the original follower. So they need both. So in terms of the gold-silver ratio, I would expect it to go down. Let's bring up that chart because your question was originally on that. And then explain why did we say careful. You can't say exclusively that the top is in on the gold and silver ratio. And I want to remind people of those details of why we said that. Right now, we are having a bleed-out crisis. It's a weak economy, in my opinion. Despite the statistics, I feel that there's a lot of misrepresentation. You've had 315? I'm not quite sure. 215,000 jobs removed from the non-farm payrolls that were claimed to have been done just in the first half of the year. So as well as Happy America Day, happy H2 for everybody else, we're into the second half of the year. So I'd expect this to continue down. But the warning is, if you suddenly get a crisis, you see continue down, there's a bullish phase, continue down. If you suddenly get a major escalation in the crisis, that there's a dash for liquidity, where everyone panics and even gold sells off a little bit because nobody's got any money. Let's say global bank hack, pandemic Mark II, a shock and awe event of an economic nature or non-economic nature but has economic repercussions like World War III. Anything of that nature. And I do feel we're being set up for some big problem to come. What tends to happen is everything gets sold because you have to have money. And in that environment, gold doesn't go down as far because the biggest buyers are the permanent money, the long-term money, the central banker money, and they will gobble up and they'll dump treasuries for gold. They're not going to be buying silver. And that's why silver is more volatile to the downside in a demand-destroying event type environment. And I still feel there's an event of that nature. We're bleeding out and we're managing to have a very difficult market, which is releasing some of the pressure, but I fear it will go into a capitulation and a major event at some point. That's when you get that secondary move. That's when you go there and then you still get a blow-off.
Gold is currently demonstrating strong bullish momentum as it consolidates near key resistance levels supported by important moving averages, suggesting that buyers remain firmly in control and the uptrend is intact. This pause in price action is seen as a healthy consolidation before a likely breakout higher, fueled by ongoing economic uncertainty and sustained demand for safe haven assets. Similarly, silver is showing encouraging signs of strength, having rebounded from critical support and broken through recent consolidation, indicating it is preparing for a significant move upward. Due to its greater volatility and industrial demand, silver has the potential to outperform gold during bullish phases, making both metals attractive options for investors seeking protection against inflation, currency devaluation, and geopolitical risks. How do you anticipate gold and silver prices will perform in the near future, considering current market dynamics? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.